Welcome back to Intermediate Accounting. This video covers the effective interest rate method of amortizing premiums and discounts on bonds payable. Remember the last video we discussed the straight line method of amortization of discounts and premiums on bonds payable. The effective interest rate method is actually the method that GAAP prefers, and it's the method that most companies are going to use for amortizing the discounts and premiums on bonds payable. Remember that bonds are not always issued at par. If the stated rate on the bond or the coupon rate or the amount of interest that the bond is actually going to be paid is less than the market rate, what similar bonds would pay, then the bond would of course be issued at a discount. Investors aren't, or prospective bondholders aren't willing to pay as much for the bonds if the specific bond's coupon or stated rate is less than what it could get elsewhere. And the opposite holds true. If the stated rate on the bond is greater than the market rate, then the bond will be issued at a premium. Remember from last video, the discount or premium will be amortized over the life of the bond, which results in adjustment to interest expense. Two methods that are allowed by GAAP, as long as they're not materially different from one another, the straight line method of amortization and the effective interest rate method of amortization. As I mentioned before, this video covers the effective interest rate method of amortization. Using the effective interest method of amortization, we calculate bond interest expense as we see here, the carrying value of the bonds at the beginning of the period multiplied by the effective interest rate. The amount of the amortization is the difference between the bond interest expense and the amount of bond interest paid. Of course, the amount of bond interest paid is the face amount of the bonds times the stated interest rate. The effective interest rate method produces interest expense equal to a constant percentage of the carrying value. Okay, what is that constant percentage equal to? It's equal to the effective interest rate on the bond. Let's write out some notes here. So interest expense, we saw it in the previous slide, but let's have it in our notes. Interest expense using the effective interest method is equal to the beginning carrying value of the bond multiplied by the effective interest rate, right? What we might consider the market rate. And the amount of the amortization, remember the amortization is an adjustment to the interest expense. The amortization amount is equal to the difference between bond interest expense minus the amount of cash paid interest, the cash interest on the bond, which of course is equal to face value of the bond times the stated rate on the bond times time, of course. Bonds will either be issued, it can either be issued at a discount or a premium. What would the balance sheet report? Well, one of two things. If it is a discount bond, what you're going to see is bonds payable. This is the full face amount or maturity value of the bond, less the amount of the discount, which remember, as we amortize the discount gets smaller. And the difference will be the carrying value. So the discount gets smaller over time and the carrying value increases over time so that right at the maturity date, the carrying value is going to equal the face value of that bond payable. If the bond had been issued at a premium, the balance sheet would report bonds payable, the face value or maturity value, plus the premium. Just like the discount gets smaller over time, the premium gets smaller over time. But as the premium gets smaller over time, it causes the carrying value of the bonds payable to also get smaller over time. So the carrying value of a discount bond increases over time. The carrying value of a premium bond will decrease over time. However, in both cases, the carrying value at maturity will reach the face value of the bonds payable. Let's take a look at an example. Evermaster Corporation issued 100,000 of 8% term bonds on January 1st, 2020 through on January 1st, 2025, with interest payable each July 1st and January 1st. Investors require an effective interest rate of 10%. So we see here that the stated rate is 8% and the effective or market rate is 10%. So we're told here that the bonds were issued at a discount, but anytime the stated rate or the rate that the bond is actually going to pay in cash is less than what other similar bonds are offering, of course, this bond is going to be issued at a discount. This slide says calculate the bond proceeds. Now in class, we're not going to be, or on exam, we're not going to be asked to calculate the amount of the proceeds, but let's just quickly see how we would do that. To calculate the present value or the cash proceeds at issuance date of the bond, we use our present value function. We put in the interest rate. We're going to use the market rate. 10% is received twice a year. So at each interest payment, there's going to be 5% or 10% divided by 2. The number of periods, this is a 5-year bond with interest paid semi-annually, so 5 times 2 or 10 interest periods. Payment, what is the bond going to pay each time a payment is going to be made? 100,000 times 0.08 times 6 out of 12. The future value is the face value of the bond, or the amount that the company is going to have to repay at maturity, which is 100,000. Payments are made at the end of the year, so type is 0. And we get the present value of the bond, rounded to the nearest dollar, 92,278. Now we don't need to know how to calculate that. That amount will be given to us in our problems, but this helps us understand where that amount is coming from. Let's record the journal entry that would be booked on the date of the issuance of the bond, January 1st, 2020. Now I want you to note that the entry at issuance is the exact same regardless of whether the straight line method of amortization is used or the effective interest rate method. The company receives cash. We said the cash price was 92, the cash received is 92,278. That was the present value of the bond based on these terms and a market rate of 10%. We're going to credit bonds payable for the face value of the bonds, which is 100,000. And the difference is going to be recorded to discount on bonds payable, the contra liability account. $7,722. The next journal entry that's going to be required is on July 1st, the next interest payment date. And that time, of course, we're going to have a debit to interest expense. We're making a cash payment for interest, so of course we're going to credit cash. And we're also going to need to record an entry, just like we did, and looking just at accounts. It's going to be very similar to what we did using the straight line method, where we're reducing the balance in the discount on bonds payable. The discount always carries a debit balance. So in order to decrease the balance in the discount or amortize the balance in the discount, we're going to book a credit to discount on bonds payable. Let's solve for interest expense. And remember, with the effective interest rate method, interest expense is going to be calculated differently than it was under the straight line method. I'll write some notes down here. So remember that interest expense, let me start off with the components of interest expense. To solve for interest expense, what we need to do is take the beginning carrying value of the bond and multiply it by the effective or market rate of interest on going out there for some similar bonds. And of course, multiply this by any time. This is a semi-annual bond, so this will be 6 out of 12. And beginning carrying value times the effective rate times time is going to give us interest expense. We know the effective rate that's given to us as 10%. So what is the beginning carrying value of the bond? When we issue the bond, we're going to issue it at its beginning carrying value, the bond payable balance less the full discount. So 92278 is the beginning value. And this represents the balance in the bond payable account less the discount at issuance. 7,722. Gives us 92,278 times 10% times 6 out of 12. This gives us interest expense of 4,614. Debit interest expense 4,614. The amount of the discount is going to be the difference between the interest expense and the cash payment. So as we can see, we can't solve for the discount yet until we put in the amount of the cash payment, and then the discount amortization is going to be the difference between the interest expense and the cash payment. So what is the amount of the cash payment on the interest? Well, that's easy. As with any bond, take the face value, multiply it by the stated rate, which we're told is 8%, and these bonds are semi-annual, so we have to multiply this by 6 out of 12, so 4,000. Remember, amortization of a discount increases interest expense. So while we're amortizing or decreasing the discount for the difference, 614, that results in an increase in interest expense. The next journal entry is on December 31st. It's year end. We need to account for the fact that we've accrued interest, or we need to accrue interest from the last time an interest payment was made, July 1st, through December 31st. So this entry is going to look the same as the last one in terms of accounts, but the dollar amounts are going to change for the interest expense and the discount amortization. We're going to debit interest expense. We're going to credit to reduce the discount account. Now we're not paying the cash. If it's today's December 31st, we'll pay the cash tomorrow, but we want our balance sheet to reflect the fact that we owe. Tomorrow we're going to be paying off on this interest. So we increase the liability account interest payable. Now the interest payable, that amount is not going to change. Tomorrow we need to make January 1st, we need to make the 4,000 cash payment. So right now we're increasing our interest payable by that same 4,000, calculated as the 100,000 face value times the 8% stated rate times 6 out of 12 semi-annual bond. Now when we're calculating the interest expense, just like we did before, we're going to take the beginning carrying value, but remember that beginning carrying value has changed. Why is the beginning carrying value changed? So the last time when we used the beginning carrying value of 92,278, this was the carrying value date of issuance. Since then, on July 1st, we booked this entry. We reduced the discount by 614, which means we increased the carrying value by 614. So there's two ways that we can get to the beginning carrying value for the December 31st entry. We can take this beginning carrying value of 92,278 and we can add the discount amortization, or we can look at this as the 100,000 face value less the balance in the discount account once we've amortized the 614. It's probably easier to just say our previous beginning carrying value was 92,278. And if we reduced the discount by 614, what we're doing is increasing the previous carrying value. So the beginning carrying value is 92,892. and we multiply that by the effective or market interest rate, 10%, and we multiply that by the time. It's been 6 out of 12 months since we've last recorded this, or 10% divided by 2. And when we take 892, and multiply it by what is essentially 5%, we get interest expense of $4,645. The discount on bonds payable is simply the difference between the interest expense and the cash paid. So the discount is amortized and reduced by $645. And what we see here in this next slide, this is a discount amortization schedule. And so we see how each amount was calculated for the July 1st entry. It's shown highlighted in red here. We know the amount of the cash payment, period twice a year, $4,000 cash paid. We see the amount of the interest expense, which is here in B, beginning carrying value at 7,120 times the effective rate times 6/12 gives us the carrying value. Cash paid in 1/1/21, 4,000. The interest expense for January 1st, 2021 is equivalent to our previous carrying value, 92,892 times 10% effective rate times 6/12, and that gives us 4,645. The difference between the interest expense and the cash payment is the amount of the discount amortization. We can see how this continues all the way through the life of the bonds until finally the discount is fully amortized and the carrying value reaches its face value. Let's now look at an example of a bond being issued at a premium and how we're going to use the effective interest rate method of amortization on a bond that was issued at a premium. Evermaster Corporation issued 100,000 of 8% bonds January 1st, 2020, due on January 1st, 2025. So far, same information as the last example. However, investors require an effective interest rate, or we can say the market rate is 6%. So if the market is offering 6% and Evermaster's bonds are paying 8%, so many people are interested, it raises the price of the bonds, and the bonds are not going to be issued for 100,000. The bonds were issued for 108,530. Let's record the journal entry for the date of at the time of the issuance on January 1st. The company receives cash of 108,530. The company records bonds payable at face value, which is 100,000. And that difference of 8,530 is recorded as a credit to the adjunct account premium on bonds payable. So once this entry is recorded, what is the carrying value of the bonds payable? It would be 108,530. So we can say the carrying value after this journal entry is recorded is 108,530. And as you know, we're going to need this carrying value when we're calculating our first interest expense at July 1st. This is what's going to be used as the beginning carrying value. Here we are asked to record the journal entry on July 1st. We're going to debit interest expense. We're going to want to decrease, remember premium amortization is a reduction to interest expense. So we decrease or debit premium on bonds payable. And July 1st, the reason we're booking entry is this is an interest payment date, so we credit to reduce cash. The amount of interest expense, let's calculate that down here. We take the beginning carrying value, which was the carrying value at issuance, 108,530. Multiply that by the effective rate, of 6%. And it's a semi-annual bond, so let's multiply this by 6 out of 12. Or we can say, let's take the 108,530, the beginning carrying value, and multiply it by 3%, because every 6 months we're accounting for 3% of the beginning carrying value. And this is going to work out to be 3,256. We can't do the premium, the debit to the premium just yet, so we need to hold off on that. Let's solve for the cash payment amount, and that should be the easy one because regardless of whether a bond was issued at a discount, a premium, or at par, the cash payment is always equal to face value times the stated interest rate times time, in this case, 6 out of 12 months, so 4,000. And the difference between the cash payment and the interest expense is the reduction to the premium, or the premium amortization. We know when bonds are issued at a premium, the premium is counted for as a reduction to interest expense. So we should, as we do see, that interest expense is lower than the cash payment. It's lower by $744, and that's the amount of our premium amortization. On December 31st, we need our adjusting entry for the accrued interest. Again, we have our interest expense debit. Again, we're going to amortize the premium. We amortize or reduce the premium with a debit to premium on bonds payable. And we credit, we're going to pay the cash tomorrow, so at the balance sheet date, we need to credit interest payable. On July 1st, we used a beginning carrying value of 108,530, but by December 31st, the beginning carrying value is no longer 108,530 because we booked this entry here, causing specifically here this debit to premium, which caused the carrying value to decrease, right? Because the carrying value, what is carrying value? We take the bond payable, 100,000. We add the premium, the total premium amount, to get the carrying value. So what is the balance in the premium account? Well, it began at 8,530, and then we reduced it by 744. So the balance in the premium account is 7,786, giving us a carrying value of 107,786. Now, another way to calculate that, another way of saying what is the beginning carrying value beginning at this period since our last journal entry was booked, so beginning for December 31st, we can take the previous carrying value, which is what we had here, 108,530, and from that we can subtract the premium amortization that we recorded on July 1st. We reduce the premium by 744. So if we take the 108 previous carrying value, 108,530, and we subtract 744, we get 107,786. So regardless of how we get to our beginning carrying value for this December 31st entry, we get to the same amount. Beginning carrying value 107,786. Multiply this by the effective rate of 6%. This is a semi-annual bond, so times 6 out of 12, or we can say 107,786 times 3%, gives us interest expense of 3,234. So debit to interest expense, 3,234. The amount of the premium is equal to the difference between the cash interest paid, or in this case, to be payable tomorrow, and the amount of interest expense. How much of is the interest payable? Just like with the cash payment, face value of the bond, 100,000, 8% stated rate, semi-annual, so times 6 out of 12, or 4,000. So the premium on bonds payable is the difference between the interest payable, interest that will be paid out in cash tomorrow, and the amount of the interest expense. So we can see that the difference here is 766. We are reducing the premium on bonds payable by 766, which is also going to reduce the carrying value of the bonds. So we're not asked this here, but what would the carrying value of those bonds be after this journal entry is recorded? Well, we said we have a beginning carrying value here of 107,786. We would subtract 766 to get a new carrying value of 107,020. The next slide, we see an amortization schedule. Here's the carrying value we just solved for here, and you can see our the amounts that we solved in our journal entries are also shown here. Just to review the classification on the balance sheet of the discount and the premium. A bond discount is a liability. The discount is a liability valuation account. It reduces the face or maturity amount of the liability, and it is referred to as a contra account. A bond premium is also a liability valuation account. It doesn't reduce the amount of the liability, it adds to, and it is referred to not as a contra account, but as an adjunct account, because it increases the value of our liability, or the carrying value. One thing we also might want to note is that the bonds payable minus a discount gives us our carrying value of the bonds payable, and bonds payable plus a premium gives us the carrying value of the bonds payable, also known as the net carrying value. This concludes the video on amortizing the discount or premium using the effective interest rate method.